Okay, Chris, so we're going to session this morning. Chapter 10 is about, let me get this pulled up, reports and measures, reporting. You probably remember this from some of your accounting classes. The balance sheet, we have a statement of revenue expense, statement of changes in fund balance and cash flow statements. You probably remember balance sheets and P&Ls. For P&Ls are revenue and expense, changes in fund balance, net worth, and cash flow statements. And they contribute to each. Most companies, larger companies use accrual accounting. You remember again, accrual accounting is the basis is that revenue is recorded when it's earned as opposed to when payment is received, and expenses are recorded when they are incurred, but not when they're paid. Cash accounting is the other way around. Cash accounting is what some small businesses use. It's convenient because you record every single transaction as it occurs. Revenue is recorded as it comes in, as opposed to when it's actually accrued, because often we are dealing with people and billing them later. So we want to do that. Most, as it says, the most organizations are on accrual, and that's what's used through here. Balance sheet records debt and equity, debt and liability and asset debts, and then the difference is the net worth. Balance sheet is a snapshot because that changes all the time because revenues come in, expenses go out, etc. So it's the assets or the liabilities plus the net worth divided by the fund balance. So we've got, you need to be looking at that chapter and reviewing some of these concepts. Revenue and expenses, the inflow of revenue along with the outflow of expenses and the net result. So that's either an income or a loss. The statement covers a period of time. It can be whatever period you're looking at. It can be a day, a week, a month, a quarter, whatever. If the balance sheet is a snapshot, then the revenue and expense statement are diaries. Lists all of our transactions. The elements in the revenue and expense, operating revenue minus operating expenses gives us our operating income. Okay, operating income is different from what we would ultimately calculate as our net income because we have depreciation, we have a whole lot of other reductions, as you remember from your accounting. Changes in the balance and fund balance and net worth statement looks at the equity. In other words, what the company is actually worth over time. So we look at the revenue components, and we look at and go through that balance sheet according to your text, which we'll have to draw from the home module of the shell. So we have liabilities, assets, income from operations. Okay. We hope that our liabilities go down each year, our assets go up, our income goes up. Depreciation, often the accumulated depreciation should go up, and then total operating revenue comes out of what we have acquired in revenue. Remember, revenue is not profit. Revenue is just income, and everything else reduces that. The reporting elements in the statement of changes, beginning balance plus operating income is the ending balance. There's another way, beginning balance minus the operating income is the ending balance. That assumes that operating income is negative. Cash flow statement actually just looks and takes the accrual basis statements and converts them to cash flow through a series of adjustments. So a cash flow statement is written as again as things actually are accrued in our most of our businesses. So if a patient comes in and the charges are X, and the patient pays a small copay, then by accrual, the income is booked as though it has been acquired, and the actual, in terms of accounting, if you remember, when they haven't paid, it goes into accounts receivable. Our cash flow statement is basically sources and uses of funds, and the reporting elements are beginning balance of our accrual basis plus or minus the reconciled non-cash increase and the cash basis at the end. So again, you remember all of that. Subsidiary statements support these things, and the balance sheet. There are some practices here. We're not going to go through those. So I'm going to go on to the next chapter, which is 11. And chapter 11 is financial and operating ratios. Ratios are critical components of understanding the financial health of an organization. Ratios look at a number of things. They're important for a business because they're used for credit. They're also important. They're not used so much for as such for individuals, but for business reporting, these things are critical because before you can get money, borrow money, say, you must be able to prove that you can repay it. So there are three types: liquidity, solvency, and profitability. We looked at a number of these. You've probably seen them again from your accounting classes: current ratio, quick ratio, days cash on hand, receivables. Solvency is how well can we cover our debt service, and we have what are our liabilities to our fund balance. Profitability includes operating margin. Okay. Current ratio is basically current assets for current liabilities, as you remember. Quick ratio is cash and cash equivalents plus the net receivable. In other words, what are your accounts receivable divided by your current liabilities. So that is their days cash on hand. Basically, you compute your unrestricted cash, which means cash that's not already been allocated to expense, and cash equivalents, which would be bonds and so forth, divided by operating expenses, your cash operating expenses, and the number of days in the period. So you can calculate that. The days receivables, the number of operating days in the receivables. Your receivables have days, usually 30-day net, sometimes more. If you're dealing with the government, it can be a 60 or 90-day net. But, your days receivables um, are also looked at as a part of it. The solvency stuff looks at your debt service coverage ratio here, and that's the ability to meet your service. This one is critical to looking at that credit analysis. So it's the change in unrestricted net assets, meaning not already uh, designated for a specific purpose, plus interest, depreciation, and amortization over the maximum annual debt service. So we're looking at that. Solvency, um, the liabilities to fund balance represents your relationship of your liabilities to your um, to your net worth, basically. And there's a quick indicator of bad debt. Computed liabilities for fund balance. Here is the total liabilities over your unrestricted net assets or net worth. Operating margin, basically, operating margin is the operating income or loss divided by the total revenues. It's percentage. Okay, you'll see this operating margins for companies vary all over the map. For instance, operating margins for the pharmaceutical industry are well into the double digits, 25 to 35%. Total operating margins are common. Profitability is your return on total assets. In other words, you've made an investment, assets, earnings. So we look at our earnings before interest and taxes. Okay, this is an important concept, Ebbett. I'm sure you remember that from your accounting classes as well. Divided by our total assets. Again, it's percentage. Ratio analysis is used as a comparative analysis. When we're looking at that, when we're looking at those ratios, the differences between various periods should be considered, and the reasons for such differences should be sought, especially if those differences reflect negatively on corporate performance. So there's a bunch of examples, lousy slides here. Let's see, there's a bunch of examples here. Chapter 12. Time value of money. Now that is a part of our discussion for this week. So the time value of money is something to consider here. Time value of money is something that helps us make choices about where the resources should be spent. The basis for the time value of money is that, as we all know, a dollar today is worth more than a dollar tomorrow. And inflation is one reason, but also there are many other factors that can play into that. Not just inflation, but what you will be looking at in terms of what you could be getting with other forms of investment of that money. So we're going to look at the unadjusted rate of return, present value analysis, internal rate of return, and the payback period. Unadjusted rate of return looks first off needs to follow whatever depreciation method is being used by the company. The unadjusted rate of return is an estimate. It's not very precise, so a lot of people will use it for just a quick calculation of what value of this might be. And we look at the net income divided by the original investment amount, the net income that comes as a result of the investment. Okay, and that equals a rate of return. Another way of looking at it is the average annual net income divided by an average investment amount also. Um, so, so basically, if we're looking at an average annual net income and on an original investment of $1 million, then at the end of, and we look at the salvage value at the end of the useful life, which is whatever we have determined that would be. So we've got $100,000 net income over $1 million at 10% adjusted rate of return. So if that's sufficient, then we go ahead and do that. There are other examples of this. Let's look further down. Present value analysis looks at the value based on time value of money. So as you as your dollars that come in the future are worth less than they are today. So that's really what we want to look at here. Um, so present value analysis can be done by using lookup tables and it all depends on what our discount rate or whatever rate we're looking at. What discount rate is another term for how do we deflate the value of the money, and that can be compared to what the value might be if we just invested that in some form of investment. You can do these things in a spreadsheet. There is a present value function in Excel, for instance. Business calculators such as the HVAC also have a present value form. So these can be done. So we look at this. We look at the purchase price, um, um, the useful life, the revenue it will generate per year, and any direct operating costs associated with it, which is to say cost of power, personnel to run it, operate it, and so forth. So we look at the depreciation, looking at the basically we divide the purchase price by the number of years of useful life. So we are looking at that. So we can assume, for instance, the present value of we use Excel and we can do present value calculations. We need to give an interest rate. We need to give a a time period that we would need. And so basically, if we wanted to know if we need $100,000 in 15 years, how much would we have to invest today? So we do the calculation. It turns out to be $41,730. Again, we can do that with lookup tables, which are at the back of the chapter, or we can use the functions on calculators. And it changes depending on our assumption as to what we can get as a return. Quickly, internal rate of return. The interest that discount is the rate of interest that discounts the future net inflows from an investment down to the amount. It's in this case, we do this uses a discounted cash flow technique, much like a present value calculation. So we look at the initial cost of the investment, the estimated cash inflow, and the useful life expressed in the number of periods. So we do that calculation. Do we divide the initial cost by the estimated annual cash flow? The answer will be a ratio. We look up again, a lookup table as it's described. We can find the number of periods, find the column approximating the ratio previously computed. It won't be perfect. And that figure in that column is the interest rate approximating the rate of return. It can also be computed through Excel or a business calculator. So we can look at this. If the initial investment is this much, 16,950, estimated cash inflow generating $3,000 and a useful life of 10 years. We've got divide the initial cost by the $3,000. We get a ratio of 5.65. Using that table, we find a line number um, uh, for the present value of annuity of $1, which is found. We use this uh, ratio number to get there. Look across to the 10-year line, and we find out that the rate of return is 12%. So we can use this for any number of different things. Payback period basically is how long is it going to take to pay back the cost. And again, that is, we need to know the purchase price, the useful life, revenue per year, any related direct operating costs, power, um, people, someone to actually run it, and then our depreciation. The payback period is basically how long is it going to take us to get the investment back? We don't get it back the first year usually. So if we look at this again, the purchase price is 500,000, 10 years, revenue 84,000, direct operating costs and depreciation. We've got all that put together. The net income after taxes is going to be revenues, direct operating costs, depreciation, net income $13,000. The net annual inflow it's expected to generate, we're adding back the depreciation. We come up with $63,000 because we get that money back, that $50,000 each year. Net annual, how many years it's going to take. So we are dividing a cost of $500,000 by $63,000 per year. So 7.9 years, we're going to pay back the machine out of a 10-year life. So basically, that's how that is done. Okay. The future value of any interest can be, of any investment can be, again, calculated. Future value is another function that you can find in Excel. And if you look at this, if the interest rate, if we start with a balance of say $9,000 at 6%, in 5 years, how much will be there? Basically, it's going to be compound interest. Use a compound interest table or again the future value table. So our $5,000 that we've invested, $9,000 we've invested, is going to be worth $12,042 in 5 years. So there's lots of ways of doing that as well. Get rid of that. We're going to go to chapter 13 now. Is trend analysis and forecast data. Common sizing. This is basically putting everything on the same relative basis. So if we look at numbers, we're looking at percentages so that we can compare across systems, departments, and across different divisions of a company. So what we're looking at is we're looking at these two hospitals, and what we're looking at the assets in both. And you see that even though there's a great difference between the monetary value, the percentages, current assets versus PP&E and other assets, are the same across these hospitals. So we can also see how they change from year to year. So in this hospital, we've got a change. Current liabilities go from 100,000 to 500,000. But note that our current total liabilities have gone from 500,000 to 2 million. So long-term debt changes. Obviously, we've got a lot of money here, so we can compare as to how these things change over time. That tells us a lot about the health of the company. Well, so we can look at this again. We can look at differences, and the difference here. If we go from current assets, we can be looking at changes in these things as well. So we convert money to percentages, and because we need to do that, we use this for forecasting. So we're going to use short, intermediate, and long range, and we got lots of approaches, several approaches and sources of information. Revenue, staffing, and operating expense are the most common type. So what we look at is we have to make a lot of assumptions in doing this. This means that a lot of thought must go in, and we are, especially when we're forecasting for expenses and budgets and so forth. An awful lot of information has to go in. This list here has a lot of information as well of the kinds of things that you have to assume. So some examples, some exercises here. Forecasting and budgeting. Budgeting is a forecast, but you need to be looking seriously at how you go about that. So there's some exercises here you should read through. You do need to read these chapters. There's some very important things. Staffing forecasts have to take into account a lot of different things. Scheduling, how many, and what we anticipate in terms of staffing of scheduling needs. What kind of facility are we? If you're talking about a doctor's office, you're only worried about 9 to 5, basically. If you're talking about a nursing home, it's 24/7. So we need to. There are several issues in forecasting that need to be looked at. And then you have to look at when you're looking at expansion, you need to look at your forecasting needs. So we're going to quit here for today. I will go ahead and convert this and post it. When you read this, I'd like you to send me an email with the word Penang, PENANG, in the email to let me know that you've read this. If you have any questions, please contact me. I will be more than happy to talk with you. So that will be all for today, and I'll talk with you on Thursday.